Imagine running a business where you intentionally sell fewer products.
Yeah.
You bring in less total revenue, but somehow you end up making significantly more money at the end of the day.
Yeah, it sounds like a mistake on the balance sheet.
Right. But that is the exact paradox we are unpacking today with Booz Allen Hamilton's Q1 2027 earnings call. And welcome, by the way, to the deep dive.
Glad to be here.
So if you hold this stock, or maybe you're considering it, or just trying to understand how modern defense tech is completely transforming, this quarter is a masterclass in why reading a simple press release will completely blind you to a company's actual health.
Oh, totally.
So today, our mission is to be your personal financial translators. We're taking a data-forward look at this company, which operates under the ticker symbol BAH. We're going to hit the headline numbers, uncover the real story driving those results, break down management's guidance, and finally give you an actionable bottom line.
Because, in a world of just absolute information overload, the true value of an earnings call isn't in those glossy opening remarks they read off a prompter.
Yeah, the scripted stuff.
Exactly. The real insight lives deep in the Q&A section. That's where management actually has to defend their strategy, their capital allocation, and their macro assumptions to the analysts. And Booz Allen is currently undergoing this radical internal transformation. And the friction of that change is, well, it's highly visible in their financial reporting this quarter.
Okay, let's unpack this. Because right out of the gate, the headline numbers present an immediate mystery.
They really do.
Revenue for Q1 declined 4.2% year over year, landing at $2.8 billion. So a casual observer might see a top-line contraction and just assume the business is losing ground, right?
Right, which is the logical first thought.
But then you look at adjusted diluted earnings per share, or EPS, and it jumped a massive 22% to $1.81. Adjusted EBITDA came in at $334 million, pushing margins up 130 basis points to 11.9%.
Wow.
Yeah. And their free cash flow was exceptionally strong at $261 million. So how does that happen?
Well, the divergence there, between revenue dropping and profit soaring, that requires us to look under the hood of those specific profitability metrics. When we talk about adjusted EBITDA margin, we're looking at the core operational profitability of the business, right? Before taxes, interest, and all those weird accounting quirks are factored in.
The core business engine.
Exactly. And seeing that expand by 130 basis points, that is a major signal that the underlying unit economics of the services they're providing are fundamentally changing.
So they're getting more efficient.
Highly efficient. And that 22% spike in EPS, which, just as a reminder, represents the profit allocated to each outstanding share of stock, that was driven by real operational profit growth, a lower tax rate, and a reduced share count from active stock buybacks.
Got it. Though we do need to isolate one data point here, just to be completely objective.
Right.
That EPS number did benefit from a $19 million pre-tax unrealized gain on the venture investment.
Right, yeah. Which is a nice windfall, but it's not recurring revenue.
Exactly. But taking that $19 million VC windfall out of the equation still leaves a core profitability trend that is undeniably strong. They are generating significantly more profit out of a much smaller revenue base.
Yeah, the math is fascinating.
To make sense of this, I like to think of it like a popular high-volume restaurant, right?
Yeah.
Imagine they suddenly decide to shut down their busy lunch service to focus entirely on this exclusive, highly expensive dinner menu.
I like that analogy, yeah.
Right. So the total number of meals sold, the top-line revenue went down. But because they're charging a massive premium for those dinner steaks, the profit per meal, their margin, went up so much that the owner actually took home more cash at the end of the day. They are deliberately choosing the quality of their revenue over the sheer quantity of it.
That's a perfect way to frame it. And management essentially painted a picture of a business operating in a highly bifurcated market to achieve that exact dynamic.
What do you mean by bifurcated?
Well, they're managing two very different realities simultaneously right now. On one side, you have their civil business. This is the division working with domestic, non-defense government agencies. And this segment saw a steep 16% revenue decline.
Okay, so if the civil sector is that lunch menu they are shedding, the drag on those numbers must be coming from the expiration of older projects.
Exactly.
Because based on the call, they had several large legacy contracts roll off.
Yeah.
They specifically mentioned impacts within the Treasury Department. Mm-hmm. And we also know last year had a generally slower award environment, meaning there were just fewer new program starts to replace the old ones.
Yeah. And even when they are winning recompetes, keeping a contract they already had, the new versions of those agreements are generally smaller in scope. and shorter in duration.
So they're shrinking by design, in a way.
Yeah, and that structural downsizing in the civil space forces a pivot. They are heavily leaning into their national security portfolio to drive those higher margins we talked about. They actually recently combined their defense and intel divisions into this single national security bucket because the technologies they deploy now, they cut across all military and intelligence domains. This side of the business grew 1% in revenue for the quarter.
A 1% growth rate doesn't sound like a massive high-end dinner boom just yet.
No, it doesn't.
But that is only what actually hit the books and was billed this quarter, right? The forward-looking indicator is the pipeline. And their funded backlog for national security spiked an incredible 23%.
Which is huge.
Yeah. It brings us to a really vital health metric for any government contractor, which is the book-to-bill ratio. For Q1, Booz Allen reported a book-to-bill ratio of 1.5x, meaning for every $1 of completed work they billed to the government this quarter, they booked $1.50 in new future work.
And that is exactly what you want to see. A sustained ratio over 1.0 proves the business is growing its pipeline significantly faster than it's burning through its current obligations. That 1.5x metric is the direct catalyst for their total funded backlog jumping 15% year over year to $4.7 billion. The demand signal from the Department of Defense is absolutely flashing green. They are simply waiting to execute on those awarded dollars.
So they have the work lined up.
Yes, but the margin growth isn't just about winning more defense contracts. There is this massive structural shift happening in government procurement that Booz Allen is perfectly positioned to exploit.
Okay, tell me about that.
Well, building on recent executive orders, the government is aggressively mandating a move toward firm fixed price, or what they call outcomes-based contracts, as the default standard.
Right, because historically, a massive percentage of defense and consulting work was done on these cost-plus contracts.
Exactly.
Where the government would pay the contractor for all their labor and material expenses, plus a guaranteed percentage fee as profit, which is incredibly safe for the contractor.
Super safe.
But it completely removes any incentive for speed or efficiency. In fact, a cost-plus model perversely incentivizes a contractor to throw as many warm bodies in a problem for as long as possible, which is exactly why so many legacy defense programs ran years behind schedule and billions over budget.
Yeah, we've all seen the headlines about those projects.
So the DoD is finally trying to stop that bleed by saying, here's a fixed amount of money, deliver this specific technological outcome.
Exactly. And the risk dynamics completely invert under this new model.
See, I'm looking at this shift to fixed price, and it seems incredibly risky from the outside.
Oh, it is.
Right. Because if a highly complex AI software project goes wildly over budget or takes twice as many engineers as originally projected, the government doesn't bail them out anymore. Booz Allen has to eat that extra cost entirely.
That's the reality, yeah.
So why is management actively advocating for a procurement model where they are forced to absorb all of that execution risk?
What's fascinating here is that management views that execution risk as their primary competitive advantage. Yeah. The fixed price model heavily rewards deep technological competence. If Booz Allen signs a contract to build a cyber defense platform for $50 million, and they utilize their own proprietary AI accelerators and highly skilled engineers to deliver it flawlessly for, say, $30 million, they get to keep that $20 million difference as pure profit.
Oh, wow. So the efficiency directly pads their bottom line.
Precisely. They are no longer simply passing labor costs along for a flat, low single-digit fee. They are getting paid for the value of the outcome. Management explicitly stated during the Q&A that this flexibility gives them the opportunity to bring greater value to customers and support much stronger financial performance over time.
Makes sense.
This transition from a staffing model to an outcomes-based tech model is the exact mechanism driving their margins toward 12%.
Okay, so they are shedding the lower margin civil work and betting heavily on these high margin national security projects. But to justify charging a premium for those fewer, highly profitable contracts, Booz Allen has to offer capabilities the government cannot easily build themselves or just buy off the shelf.
Right.
And based on this call, they believe that capability is rooted heavily in cyber, defense tech, and specifically agentic AI. I think this is a term we really need to clearly define because it's moving past the hype cycle and into actual deployment.
Yeah, it's definitely not just a buzzword anymore.
Exactly. Agentic AI is not a chatbot that drafts emails or summarizes your PDFs. It refers to artificial intelligence that actually has agency. It can act autonomously, make decisions, string together complex workflows, and execute tasks on its own without a human constantly supervising or clicking an approval button.
And in the cybersecurity domain, agentic AI changes the entire paradigm of national defense. Management highlighted that we have entered this new era where offensive cyber tools, the malware and intrusion methods utilized by state-sponsored adversaries, they are becoming highly autonomous.
Which is terrifying.
It really is. They move laterally through networks faster, they're more persistent, and they can literally rewrite their own code to evade traditional detection.
So a human sitting in a security operations center looking at a dashboard is effectively obsolete against that kind of threat.
Basically, yeah.
Because if an autonomous malware breaches a system, it doesn't wait for a human analyst to finish their coffee and review a log file. It exfiltrates data or shuts down critical infrastructure in milliseconds. To fight an AI attacking at machine speed, the government requires an AI defending at machine speed.
Exactly. And Booz Allen is deploying a suite of agentic cyber products called Velox alongside a new product they detailed called Ranger to meet this exact requirement. These are tools designed to monitor networks, instantly understand anomalies, autonomously remediate vulnerabilities, and isolate threats before a human operator even receives a notification.
They're literally selling the capability to fight autonomous digital wars.
Yeah, that's exactly what it is. And they aren't strictly confined to software either.
Right.
The call highlighted a major expansion in hardware and ruggedized defense tech, specifically pointing to their strategic agreement to acquire Ultra IMC Mission Solutions, which is expected to close in Q2.
Which directly beefs up their portfolio in command and control battle management, often referred to as C3BM, as well as encryption and edge computing.
And edge computing is an absolutely critical requirement for the modern military. This acquisition gives them immediate proprietary hardware capabilities in that space.
Let's visualize the physics of why edge computing is so necessary, because I think it helps to really picture it. Imagine a forward-deployed tactical unit operating in a highly contested environment.
Okay.
They are generating massive amounts of data from drone feeds, acoustic sensors, and targeting systems that need instant AI analysis.
Yeah.
But a sophisticated adversary has jammed their satellite uplinks and destroyed the local cell towers.
So they're completely cut off.
Exactly. They cannot simply pipe terabytes of video data back to a massive cloud server farm in Virginia for processing. Edge computing is like giving that unit a ruggedized, highly secure supercomputer that fits in a backpack or a Humvee.
That's a great way to describe it.
It processes the complex AI algorithms locally, right there at the tactical edge, flawlessly, without requiring any outside internet connection.
And that capability to operate in environments where bandwidth and power are severely restricted is exactly what the Department of Defense is aggressively funding right now. We see the market validating Booz Allen's strategy through actual contract awards, too.
Like it.
Well, during this quarter, they secured a massive $2.7 billion renewal for EMA PS3. This is an enterprise management and planning system contract, which is effectively a massive agency-wide vehicle for the government to procure large-scale data and AI integration services. Securing their largest award ever in this specific domain proves the government trusts them to handle mission-critical modernization.
Yeah, that's huge validation. They're also pushing the boundaries into next-generation computing. They secured their largest pure quantum win to date, which spans commercial, national security, and civil markets.
Right.
And crucially, they are not trying to build all these foundational models from scratch in a vacuum. They're actively partnering with the biggest hyperscalers on the planet. The call specifically referenced deep integrations with NVIDIA, AWS, OpenAI, Anthropic, highlighting a secure deployment initiative called Project Glasswing and Shield AI.
Because their strategy here is to act as the premier highly cleared integrator.
Oh, that makes sense.
Yeah, they take the absolute frontier models developed by these massive tech giants, they secure them, harden them against adversarial attacks, and make them governable for highly classified, air-gapped government environments where a single data leak is literally a matter of national security.
Okay, but here's where it gets really interesting.
Okay.
We've established they have an elite tech stack, deep hyperscaler partnerships, and the government clearly wants their services evidenced by that 23% jump in the national security backlog and a 1.5x book-to-bill ratio.
Right, the demand is there.
And they just posted 11.9% margins. Yet, when management reaffirmed their guidance for the full year, they sounded incredibly cautious.
They did.
They expect national security to grow in the mid-single digits, civil to continue declining in the high single digits, and crucially, they expect their overall margins to step back down to roughly 11% for the full year. From an investor's perspective, guiding down to 11% after just printing 11.9%, it feels like extreme sandbagging just to easily beat expectations in future quarters.
It does feel like that, but if we connect this cautious guidance to the broader macroeconomic picture, it isn't sandbagging, it's structural realism.
How so?
The flow of revenue for a defense contractor is entirely dependent on the congressional calendar, and we are in a highly contentious election year. During the Q&A, management neutrally outlined 4 distinct legislative hurdles that introduce massive funding uncertainty for the back half of their fiscal year.
Okay, what are they?
First, Congress must pass the NDAA, the National Defense Authorization Act, which sets the actual policy and funding levels for the military. Second, there is a very high statistical likelihood of a continuing resolution, or CR.
Right, and a continuing resolution is a massive bottleneck for a company transitioning to new technology.
Yeah.
Because legally, a CR freezes federal spending at the previous year's levels.
Correct.
But more importantly, it prohibits government agencies from initiating any new program starts. So Booz Allen has this $4.7 billion funded backlog. But if a CR hits in October, the Department of Defense cannot legally sign the checks to begin those new agentic AI or edge computing projects until a formal full-year budget is passed.
And that dynamic effectively freezes their revenue pipeline. Management also cited the potential for a reconciliation bill and the uncertainty surrounding supplemental funding packages as additional variables. How these 4 pieces of legislation are navigated by Congress will directly dictate whether the government can actually convert Booz Allen's massive backlog into recognized revenue.
So it's a timing issue.
Yeah. It is completely out of the company's control, which necessitates that cautious 11% margin guidance as they absorb the final roll-offs of those higher margin legacy programs and prepare for what they hope will be a back half-weighted growth ramp once the budget actually clears.
But even with those legislative headwinds looming, they are actively deploying capital rather than hoarding cash out of fear.
Oh, absolutely.
In Q1 alone, they deployed $447 million. $324 million of that was allocated to the Ultra IMC Mission Solutions acquisition, beefing up that defense tech hardware portfolio we discussed, along with several strategic venture investments.
Right.
And the remaining $123 million was returned directly to shareholders through dividends and stock buybacks, which obviously contributed to that 22% EPS spike.
Yeah, they're putting money to work. But beyond the congressional delays, management did highlight one severe operational bottleneck they have to solve internally.
Took step.
They need to rapidly accelerate the hiring of cleared personnel. There's a massive supply constraint in the labor market when trying to find individuals who possess elite-level AI and cyber engineering skills who also hold active top-secret security clearances.
That's a rare combination.
Very rare. If you want to execute on a 23% larger national security backlog, you need cleared people sitting in secure facilities actually doing the work.
Yeah, you can't just outsource that to anyone. Well, we've covered a tremendous amount of ground here. The top-line revenue drop contrasting with that massive EPS spike, the calculated shedding of the civil business, the critical transition from cost-plus to high-margin fixed-price contracts, or I should say the deployment of autonomous agentic AI.
Yeah.
And, of course, the very real election year budget risks. So let's synthesize all of this into a clear bottom line.
Let's do it.
If you hold Booz Allen stock or you are looking to initiate a position, the verdict on this earnings call is that this was a fundamentally strong quarter, reflecting a painful but very necessary quality over quantity transition. The top-line revenue dip to $2.8 billion is a temporary symptom of legacy, lower-margin civil contracts rolling off the books.
Exactly. The underlying engine of the business is accelerating. The 22% jump in earnings per share, the margin expansion nearly touching 12%, and that explosive 23% jump in national security backlog, they all demonstrate a company successfully executing a pivot away from traditional low-margin government consulting and moving aggressively toward high-margin defense tech and AI integration.
Right. So what does this all mean for you as an investor? If you are analyzing Booz Allen Hamilton today, you have to fundamentally update your mental model of the company.
Yeah.
You are no longer looking at a legacy government staffing firm that gets paid to write white papers and provide basic IT support.
No, not at all.
You are looking at a tech-forward defense contractor betting its entire future that delivering fixed-price, autonomous AI solutions will permanently widen their profit margins. If they can execute on these outcome-based contracts with high efficiency, the upside to their profitability is significant, provided Congress actually passes a budget to fund the work.
Yeah, the budget is the big caveat. But as you digest these numbers, consider a broader structural threat on the horizon.
Okay, lay it on us.
Booz Allen is moving incredibly fast to integrate autonomous AI into national defense, and acquiring boutique hardware firms like Ultra IMC allows them to build a proprietary tech stack. But as foundational AI models become increasingly commoditized, and massive hyperscalers like Amazon, Oracle, and Microsoft continue building out their own secure, government-cleared cloud infrastructure, will Booz Allen's role as the middleman integrator remain a highly profitable necessity?
Oh, that's a great question.
Right. Or over the next decade, will they eventually be forced to compete directly for government dollars against the very tech giants they currently partner with?
Because if the Department of Defense eventually realizes they can just buy off-the-shelf AI directly from Oracle's secure cloud, the integrator's margin could evaporate. It brings us right back to our restaurant analogy. Booz Allen has successfully upgraded to the high-end dinner menu for now, but they need to ensure their proprietary recipes and edge computing hardware remain completely impossible to replicate. Because if they don't, the massive ingredient suppliers might just decide to open their own restaurant right next door and serve the government directly.
It's a fascinating dynamic to watch.
Truly. Well, thank you so much for joining us for this deep dive. Keep looking past the headlines, keep questioning the numbers, and we will catch you next time.